Jobless claims just hit a 57-year low. Sounds amazing, right? Well, that is exactly why the S&P 500 is in serious danger right now. Welcome to the labor hoarding trap. We're constantly told by the mainstream that low unemployment is the ultimate bulletproof sign of a booming economy. But in this explainer, we are taking a contrarian deep dive into that exact optical illusion, and we're going to unpack the brutal truths that those flashy headline numbers are actively hiding from you. Okay, let's dive into this because right now the market is facing a massive paradox. If jobless claims are hitting absolute historic lows, why are the leading indicators suggesting that corporate earnings and the S&P 500 by extension are actually in severe danger? To really understand this, we have to stop looking at that low jobless claim headline as a sign of health and growth and start seeing it for what it actually is, a symptom of a rigid, highly inefficient market. It's a classic case of misdiagnosing a symptom, really. What looks like robust economic health is actually just the economy holding its breath. Just look at this number, 189,000. In April 2026, the Department of Labor reported that initial jobless claims plunged to the absolute lowest level we've seen since 1969. Now, to a casual observer, sure, this looks like an economy of indomitable strength. But the brutal truth here? This figure is an optical illusion. It is masking a deep structural pathology in the corporate world right now. Think about it. When you haven't seen a metric drop this low in over 5 decades, you really have to ask yourself what underlying mechanics are artificially forcing it down. And that brings us to the core divergence of our explainer today. The mainstream narrative tells us this is all about a strong economy that's growing the labor pie. But the reality? It's a phenomenon called labor hoarding. See, companies are absolutely terrified to fire anyone, mostly because the post-pandemic hiring trauma is still so fresh in their minds. But at the exact same time, they're entirely unable to hire anyone new because of broader economic uncertainty. So they aren't laying people off, which keeps those jobless claims artificially suppressed, but the hiring engine itself has completely stalled out. It's a total deadlock. So what does this actually look like on the ground? Well, labor hoarding happens when firms just hold on to their workforce, even as their actual business activity is deteriorating. Going from late 2025 into 2026, this shifted from being a quick, temporary defensive move into a widespread structural problem. Roughly 17% of firms are now actively hoarding labor. And what that does is create a highly costly zombie workforce that just eats straight into profit margins. You literally have employees sitting on the payroll whose marginal productivity has completely stalled out. They're clocking in, sure, but output isn't growing. And because firms still have to deal with competitive wage pressures, they're forced to absorb these massive, totally inflexible labor costs. If you want proof that the labor pie isn't actually growing, you don't need to look any further than the JOLTS quits rate, which hit just 1.9% in early 2026. Now, why does that matter? Well, a healthy, vibrant economy sees workers constantly moving around, migrating to better opportunities, getting promotions, right? But this rate has been stuck at or below 2% for 8 consecutive months. That tells us workers feel completely frozen in place. They're too scared to leave their current jobs, and productivity is stalling because that natural, healthy flow of talent and innovation has just stopped cold. And this brilliantly illustrates where the math completely breaks down, practically guaranteeing an earnings recession. Look back at the fourth quarter of 2025. Labor productivity increased by just 1.8%, right? But unit labor costs, which is the cost to produce one single unit of output, surged by 4.4%. That is the exact textbook definition of wage push inflation. It's like paying $10 to manufacture a product that used to cost $5, but you literally can't raise the price tag for your consumer. Companies are paying significantly more money for significantly less output. And when that mathematical reality truly sets in, management teams are going to be forced to prioritize their balance sheets over this labor hoarding, which leads straight into a sudden, violent, margin-led recession. Now, having a bloated, expensive workforce is bad enough on its own. But what happens when you combine that vulnerability with a massive external operating cost shock? You get a catastrophe. Enter the global macro picture, specifically the 2026 Strait of Hormuz crisis. This geopolitical inflation shock is rapidly accelerating the margin compression on these exact same labor hoarding companies. A rigid, inflexible corporate balance sheet simply cannot absorb a sudden, violent spike in raw input costs. When you look at the numbers, there's a really stark divergence. In early 2026, the U.S. completely solidified its spot as the world's preeminent crude oil exporter. Volumes surged 30% to a record 5.2 million barrels per day. And yet, the global benchmark, Brent crude, nearly doubled. It jumped from $61 to well over $118 a barrel, all because the Strait of Hormuz blockade shut in millions of barrels of global supply. And as a direct result, U.S. retail gasoline spiked almost 30%. So a lot of people are scratching their heads wondering, if the U.S. is exporting record amounts of oil, why on earth are domestic prices skyrocketing?
Well, it all comes down to something called the Nelson Complexity Index, which creates what we call the heavy crude trap. See, back in the 70s and 80s, U.S. refiners spent billions of dollars upgrading their facilities to process really heavy, high-sulfur, bottom-of-the-barrel crude oil from places like Canada and Venezuela. Because they sank all that capital into these incredibly complex refineries, they literally cannot efficiently process the abundant, light, sweet crude that the U.S. shale revolution actually produces today. Think of it like trying to run a heavy diesel engine on premium unleaded gas. There's just a total chemical mismatch. So the U.S. ends up exporting its own light oil and is forced to import extremely expensive heavy sour crude, which keeps domestic energy prices firmly and unfortunately tethered to violent global macro shocks.
So bringing this back to a real-world casualty, what actually happens when a company with soaring fixed costs, like a hoarded zombie workforce and heavy debt, meets an unavoidable energy inflation shock? Well, you get the Spirit Airlines liquidation trap. This is literally the perfect case study of how quickly margin erosion turns fatal. When you take structural labor inefficiencies and smash them into soaring energy prices, the countdown to bankruptcy accelerates exponentially.
Just watch how incredibly fast the math falls apart here. The 2026 Iran war and the resulting Hormuz blockade caused U.S. jet fuel prices to practically double in just 6 weeks. We're talking going from $2.50 a gallon to $4.88 a gallon. For an ultra-low-cost carrier like Spirit, fuel suddenly went from making up 25% of their operating expenses to nearly 48.5%. When your primary input cost doubles overnight and your entire business model prevents you from passing that cost onto the consumer, your earnings are instantly destroyed. They were quite literally flying planes at a massive loss the second the wheels left the tarmac.
Now, this led to a massive misunderstanding in the retail market. Rumors started swirling about a government cash-for-shares bailout to save jobs. And a lot of retail investors mistook this intervention as a lifeline, thinking it would save their common stock. But if we look impartially at how bankruptcy law actually functions, when the government intervenes like that, they enter as a senior preferred holder. They demand incredibly strict terms that effectively wipe out existing equity, just to ensure the taxpayer is repaid first. So while the operational company might survive to keep the planes flying and people employed, the stock holding the investor's money absolutely does not. We can see exactly why this happens by looking at the legal waterfall of recovery in a Chapter 22 bankruptcy. This is the absolute priority rule. Imagine a literal waterfall of cash flowing from the top down. Catching the very first flow at the top are your super priority claims, like debtor and possession lenders. Then it flows down to secured note holders, then unsecured creditors. Way down at the bottom, at step 4, are the common shareholders. By law, everyone above step 4 must be paid in full before common shareholders see a single dime. In a liquidation trap where the debt far exceeds the actual enterprise value, that waterfall dries up long before it ever reaches the bottom. Common shares are legally earmarked for termination. It's just a brutal truth of distressed equity. Now, obviously, margin erosion destroys individual companies. But what does this all mean for the broader market? To truly understand our current 2026 environment, we have to look back at the ultimate historical parallel, which is 1969. Because today's supposedly strong labor numbers, they are actually the ultimate historical sell signal. History shows us exactly what happens when investors mistake a frozen labor market for a booming one. Now, what's really interesting and, frankly, truly alarming about this is the precision of the alignment. Back in late 1969, unemployment hit a 50-year low of 3.4%, while the economy was being strained by excessive fiscal spending and the Fed was holding rates high at 9.1% to fight off sticky inflation. Now look at the 2026 reality right next to it. Record low jobless claims, multi-decade high interest rates, and equity valuations stretching past 22 times forward earnings. Do you know what the market reaction was back in the 70s? The S&P 500 fell 37%. The setup we are looking at today is practically a mirror image. Walking through the timeline of that crash proves something absolutely crucial. The labor market is a lagging indicator. Navigating the economy using jobless claims is literally like driving a car by only looking in the rearview mirror. In September 1969, we hit peak expansion with historically low unemployment. Just 3 short months later, an 11-month recession officially began. By May 1970, the S&P 500 had suffered a violent 37% peak-to-trough decline. But notice the lag here. Unemployment didn't actually peak at 6.1% until December 1970, which was long after the recession had already begun. The low unemployment rate preceded the crash. It definitely didn't prevent it. In fact, the legendary investor Benjamin Graham documented this exact phenomenon at the time. He wrote, "The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The great boom era may have come to an end in 1969-1970. This really cements the institutional precedent for us. Mistaking a frozen, hoarded labor market for a booming, vibrant economy is a fatal error for an investor." That specific deterioration in earnings posture that Graham warned about, that is exactly what we are witnessing today, with rising unit labor costs significantly outstripping overall productivity. So, let's summarize the brutal truths we've uncovered in this explainer. First, those 189,000 jobless claims aren't a sign of economic strength. They equal a zombie workforce built entirely on labor hoarding. Second, that 1.9% JOLTS quits rate means stalled productivity because workers are simply too scared to move. Add in the heavy crude trap and the Hormuz crisis, and you have unavoidable energy inflation slamming right into those bloated corporate payrolls. And finally, when those margins inevitably break and bankruptcies hit, the absolute priority rule practically guarantees that common equity gets wiped out completely. The data is overwhelming, and the historical precedents we've looked at are crystal clear. A 57-year low in jobless claims is not the green light for a new bull market. For sure, it is the brightest red flag of the decade. So I'm going to leave you with this final thought to ponder. If low unemployment is historically the ultimate sell signal, is your portfolio truly prepared for a sudden, violent, margin-led recession?